prices are trading up a little bit this morning. We have Brent at $101 and a few pennies, but in a somewhat upward motion over the last week since the Saudi energy minister interdicted into the markets a week ago, exactly after we came off the call. He must have been listening to us and said, oh my goodness, Omar Najia is too bearish. I'm going to get on the microphone and start talking up this market, which he has done. And $10 later, we're solidly above $100 a barrel. Let's welcome Omar Najia, Global Head of Derivatives at BB Energy. May I kick off with the bad news, Omar, that you're no longer in the south of France. The good news is you're looking well. So Omar, here we are, the end of August, pretty much. And this is, while we have had the recovery in the last week, it is still the third month in a row that oil prices will close the month lower than they started.
Yeah, I think basically, people are not, there's not many people back in offices. People are slowly coming back. And I think they're going to have this, look at the market. I think, on the balance of probability now, I think that, we closed, or we're trying this, 94, 95 area, and I think we get above it. And maybe we can go to, 110. So even if you're bearish, it needs to basically test higher and then kind of break its face to the downside. But what's very interesting is if you look, I think, everything is changing. So equities are a death trap. Equities are going to basically, I think, just be massacred. But I think what we might see is actually commodities go one way and equities go another way. Usually people will talk about, something going into recession and therefore equities starting to fall and demand for commodities wanes, basically. But I think what we're seeing is basically the price. In other words, we're seeing the euro weaken so much that's basically what's causing this inflation. So if you compare the price of whatever it is, electricity, oil, energy, commodities in general, if you look at all commodities in general, compare them to the price of gold, they've moved up, but they've moved up by a factor maybe of 100%, 150%. But if you look at it in terms of the euro, it's moved up like 16, 17 times, right? So basically what's happening is the euro is cratering. Oil prices are going up. So I think what we're seeing is this US dollar euro differential move 20, 30% this year, right? From about 125 to below 1. So that's people still don't get what decimation lies ahead for Europe. The idea that, sanctions are winning and all this kind of stuff. And it's not a lack of anything. It's sanctions. It's a political decision, which is why I think that come winter, when people actually start, waking up and get slapped across the face by massive bills, you're going to see lots of political change in Europe. And I think the whole idea that basically, Russia did something without thinking and blundered and all this kind of stuff, that's all going to disappear. You're going to see I think we've already seen the emergence of a new global order, all that kind of stuff. I think the euro will get decimated, GBP as well, the yen, we're seeing that now. But I think basically the time for the dollar decimation is coming. And I think, so look at the West. You've got massive inflation. In the East, not so much. So Russia sells gas, oil, whatever you want to call it, energy, at a discount to the East, right? Because they're helping them with sanctions. And the West pays a massive premium for the same oil, for the same energy. So that's what we're going to see going forward. So I think equity is complete disaster. Oil, I think, rises from here to about 110, then makes a decision. It's either going to go from 110 down to 60, or basically ramp up. And I think the person who controls that is the Russians, depending on what they do with gas, depending what they do with commodities, depending if they say everything in rubles. Because when they say everything in rubles, it causes inflation. How? By causing the exchange rate of the euro to tumble even more. because in the beginning, the euro used to be bought by the Russians in exchange for commodities. Now, nobody wants the euro. Nobody's interested. I mean, so let's see. But I think oil, 110 makes a decision, either 60 or basically considerably higher.
Victor,
Yes.
let's go to China, where, of course, Asia is also a big part of this narrative. And Victor Yang, senior editor at JLC Network Technology. Victor, I hope you had a good summer.
Yes.
Since we saw you last, it seems to me that the situation in China, economically at least, it keeps getting less positive, let's put it that way.
Yeah.
And the forecast for the year now by most international observers is closer to 3% than 4%. What's your outlook at the moment for China's economic recovery in the remainder of this year and its appetite for oil?
Well, as you say, it indeed seems a little less positive for the time being. And now a lot of provinces, say 19 provinces, reported new infections yesterday. And so there's still this tight restrictions. So under this background, we are not so optimistic for the time, to come anytime soon. Saying when restrictions remain, a lot of activities will be restrained, and say travel and a lot of related industries and logistics and a lot will be impacted. So, and oil demand, China has a more serious surplus of oil products supplied in the first half of this year. And a lot of refineries are under quite heavy pressure, mostly state-owned refineries. So they aim to lower their stockpiles in the second half of the year. So how can they do that? On the one hand, they were projected to process a certain amount of crude oil, but on the other hand, they need to lower their stockpiles. I think they had to strike a balance between these and might lower their crude throughput. And for now, say in June and July, the country's stockpiles dropped for the first time in many, many months, say since 2020.
They what?
The stockpiles,
stockpiles of oil, inventories.
Yeah, so I say, imports plus domestic production and minus the domestic throughput. So since 2020, they have been building up fast, say about close to 2 million barrels a day in the first half of the year. And now they slow down. And this will continue in the rest of the year because
the inventories have slowed down. The building, is that because they're importing less oil?
Yes, because domestic demand, fuel demand is slow to recover, and oil refineries still had quite high stockpiles of oil products, so they need to slow down imports. And say in August, maybe just about 38 million metric tons of crude oil imports in August. And this will be about the level for the rest of the year. Say we are not going to see a significant pickup in demand yet, very soon. Yes.
Let's welcome back Dr. Charles Elinas, CEO of Cyprus Natural Hydrocarbons Company and a senior fellow at the Global Energy Center at the Atlantic Council. Dr. Charles, your thoughts as we come to the end of summer and we stand on the doorstep of Europe looking towards this winter gate with some trepidation. Does the view look as bad as the headlines are indicating?
It's looking as bad and getting worse. Energy prices are climbing by the moment. The gas prices have now reached 340 euros per megawatt hour. and electricity prices in France and in Germany have exceeded now 1,000 euros per megawatt hour. And this is not the end of it. I mean, the prices are going up. And if Nord Stream 1 is shut down completely, which is very likely because it is working on a single turbine, once the turbine packs up or goes for maintenance, it will stop supplies of gas to Germany. And storage in Europe, gas storage is sufficient to the end of to December. After that, if NS1 goes down, storage is a problem. Prices are going to go further up, and they're going to continue. The problem they see in Europe is that they don't see a bottom to it. They see the whole thing being repeated next year, 2023, to the extent that in Europe, they estimate now that the cost of energy next year may be 10-12% of Europe's GDP. Is astronomical. Europe may spend $1.3 trillion just buying gas. It's getting worse and worse. And as you probably heard, in the UK, just now they announced an 80% increase in the price of electricity. And it's only the beginning, because by April next year, it may be doubled yet again. So basically, a household in the UK may be paying as much as £6,000 per year for electricity. That's astronomical. It's and
of course, that's £6,000 after you've paid your tax. So that's like £10,000 of income or something.
Something like that. And I share Amar's view that as people now come back from holidays and they're being hit with this devastation, and it's not just that the inflation in the UK, for example, is expected to reach 18% by January. Inflation in Europe is just over 10%. The cost of borrowing is going up tremendously. So anybody with a house and a mortgage is going to be paying a lot more on mortgages than ever before. So, and salaries are not going up that much. I mean, in the UK, they are offering, pittance, so 1 or 2, 3% increases in salaries, while the inflation is well over 10%. And all these additional costs are hitting everybody. As soon as they are back from holidays at the end of August, and they face these problems, I think we're going to see political problems, people in the streets demanding a solution, which is not going to come.
What about the solution the solution that is being discussed, a price cap? I mean, at the end of the day, the energy companies, Shell and all of the others, are making absolute fortunes. So the cost of this energy seems to be all ending up in the pockets of the energy companies, rather than the actual cost of producing this gas and getting it to the shores of Europe. The margins are so massive. Is there, do you think, going to be more opportunity for a price cap to come in, or a windfall tax? Or
windfall tax is already there, but it's not solving the problem. A price cap can only come if Europe as a whole, the energy ministers are about to perhaps meet and discuss it. If Europe as a whole decides to abandon markets, take away the price away from markets and start specifying a price cap. But I don't see that happening that quickly. It's many of the Western European countries, West Europe, European countries are resisting that. So I am not so sure it's going to happen. If a price cap is placed without intervening in the markets to force that, then the governments will have to subsidize it, and they don't have the money. The money is not there. So far, it's estimated that Europe has allocated something like close to 300 billion euros to deal with the crisis. And that was before we saw these recent rises. These rises have gone way beyond that. 300 billion, it's not enough to deal with the crisis. A lot more is needed. Where is it going to come from? The money is not there.
Omar, I wanted to get your views on the Saudi minister's comments last Monday. I mean, there's many sort of views on analysis on why he said what he said, and I certainly have my own views that other than what he actually said, the reason was. But I wanted to get your views on the reasons he gave, which was that there was too much volatility, it was discouraging hedging, and it was structurally disruptive to future demand in the market. Your thoughts on what he actually said and the reasons he gave, and how valid are they or not?
Okay, so if you take a step back, right? The people who control the world, so the EU, US, said to everybody that we're going green. So they said to, let's take Saudi Arabia, they said to Saudi Arabia, look, you're great, but we don't need you anymore. Nobody's going to use your oil, we're all going to be green, and you'll surplus the requirements, and there's the door, right? Then we had this crisis, right? So and then they decided, we're going to sanction Russia because they're bad. And then they found that because they had none of this energy, they were basically in trouble. So what did the Russians do? The Russians went to the Saudis and they said to them, look, this is the deal. They're going to cut all our heads off. And because of green, they're going to destroy all our economies, everything. We're done. So let's get together. Let's have OPEC plus. Let's cut, let's whatever, and increase prices. And that's what they've done. And they will continue to do that going forwards. There's nothing that cements a partnership more than when you threaten people's livelihoods. So we're going to see it, like Charles was saying, politically, because of this, inflation and electricity and gas and all this kind of stuff. But we're also seeing it with OPEC plus and with Saudi in terms of controlling this market. So both markets, equity markets and oil markets, are controlled, even commodity markets now. So they are manipulated in such a way to push people to either buy or sell or whatever it is.
So how, as a trader, can you trade that if it's that
basically
sort of Machiavellian in some ways?
The difference is that that OPEC can control the market, and the Fed and the BOE and the Bank of Japan and the Bank of the ECB. They've lost it. They've lost control. They don't know what to do. Inflation is rocketing. All they can do is increase interest rates, which crushes economies. And never forget that when we used to have an economy that was basically, the real economy was always larger than the financial economy. Right now, the financial economy is about 2 to 3 times the size of the real economy. Forget it. So two markets. One, they can't control anymore. They've lost it. All they've done basically is increase liquidity over and printed more money, more. That's all they can do. That's it. There's no other tools available. So the value of fiat currency has gone down. Meanwhile, the price at which you bought commodities was the same. So as the fiat currency real value went down, the price of the commodity stayed the same. Right now, they've said no more. We're not going to accept your euro. We're not going to accept your dollar. You have to pay in rubles, which means that the price of these commodities, these currencies decreases, the ruble goes up, commodity prices in real terms skyrocket, hence inflation. So Saudi is on board. You are not going to see a breakup of this OPEC plus. It's a very simple idea. They want to basically destroy our economies by going green. And Russia's offered the Saudis a lifeline, and they'll take it.
Victor, I wanted to get, obviously, the economic situation in China over the last year to date has been very much driven by the narrative of the zero COVID policy, the shutdowns, the no tolerance for any infection, and with that, the economic performance has declined. But my question to you is that the biggest impact, or are that we have the drought, the heat, the supply chain, logistics, the demographic, water. I mean, all of these other problems that China now faces. How significant are they, or would everything be solved if the zero policy on COVID was stopped tomorrow?
Well, the biggest challenge is still from the virus. And the country continues with this zero tolerance policy because, well, once the country opens it up, there might be more damage. That's what, well, we have been told to, at least. And as for other challenges, say the drought, the floods, well, we are not expecting to see this last long. Say the drought in Sichuan province and Chongqing. Well, when the temperatures drop, and even in the coming days, we're expecting floods in Sichuan in the coming days, say, where it's dry now. So I was quite surprised to hear this from the CCTV this morning. Say Sichuan province is preparing for floods in the near term.
Well, from drought to frost.
Yes, for floods, yes, for floods, for heavy rain in the coming days. And in the past months also, it has been dried up, has been, well, touched by, say, over 40 degrees of temperatures. So that's quite extreme. But on the whole, other damages, say the power shortage is just quite limited to mostly to Sichuan province and several other provinces, but not as serious as in Sichuan province. So the biggest issue for now is still from the virus, and we don't know how soon this can come to an end, but we're not expecting it to come to an end soon yet. And
the premier of China did make comments earlier in August that said we have to have a balance between the economy and the virus. Yes. Is that idea becoming real? Do you think that's a policy yet?
Yeah, well, it's still mostly a policy, I would say, because, well, say now some local governments have actually tightened up their restrictions, well, lately because they had reported new infections. And even in at least two cities, they tested some positive cases a few days ago, and they decided to, I think one is in Shijiazhuang city in northern China, to temporarily stop public transport for 7 days for massive testing. So actually, local governments have stepped up this kind of restriction because, well, they would be accountable if, well, this virus spread in the city. And so we have not seen such a balance yet between the virus control and, as well, not yet. Yes.
Let's go to the survey question that we have this morning regarding the outlook for oil prices. As we said at the beginning of the podcast, that this is the third straight monthly drop, even though oil prices are still $100 a barrel. They were a month ago 110, and a month before that 120 or so. So we are on a downward decline, but obviously at a very high level. My question today is, will this trend continue in September? This downward trend. So we finish the month of August probably at 100, 101 on Brent. Will September see a decline, or I suppose the opposite of a decline is a rise or flat? But the thoughts of this room, will this trend continue? Yes or no? Charles, looking at the situation in Europe, inevitably, as you articulated, and we've had that analysis from Wood Mackenzie and others, Energy Aspects, that Europe could run out of gas from its storage in the first quarter January, February, depending on how cold the winter is. What is the immediate solution to that other than obviously Armageddon freezing? But why are we not seeing that reflected in the oil price, that demand destruction of that scale? Obviously, this is gas, but where do you think Europe goes with the solution other than burning their furniture?
Burning coal. But there is the problem. The problem is more than that. I mean, we have in France 31 out of 56 nuclear plants shut down because of problems in maintenance. Norway is not exporting, is stopping exports of electricity to Europe because of drought. France, as a result of that, instead of exporting electricity, now needs to import electricity. Drought has caused rivers like the Rhine to become unnavigable. So it's very difficult to move
coal,
barges and coal up the river. But in general, Europe is moving back to coal in a big way where possible, and not necessarily to oil. I mean, Europe is still sticking to its plan to cut Russian oil down to zero by the end of the year. They haven't changed that, and I don't think they will change that. The situation is dire. I don't think there are easy solutions. So as a result, more gas is being used, and the estimate that gas will run out by first quarter may be optimistic. Gas may run out by the end of the year as a result of these problems. The high temperatures also caused high usage of energy, of electricity for air conditioning and so on. It's diabolical. There are no clear answers. Nobody knows where to turn, and it's surprising to actually see the European governments almost paralyzed. They don't know exactly what to do, and they're deferring decisions. I mean,
yet the surprising thing is, I mean, of all the things to be surprised of, the German economy still showed growth in the second quarter, even though it was very small, but it still showed growth. And the German stock exchange, the DAX index, is still close to 40 or 50% above where it traded pre-COVID. It doesn't look like Germany has yet had a heart attack.
Well, I mean, we have to remember that this has an impact, but it's not the whole. It's not the whole. The whole economy is not destroyed. The rest of the economy still functions. I mean, in Europe in general, some countries may go into recession, but not all countries will go into recession. Even Greece has just come out of being out of its problems. And now they expect growth this year to go as high as 5%, simply because of tourism. So it's not doom and gloom everywhere, but it's the energy sector that is suffering, not necessarily everything else. UK is the country that is seeing most of the problems because they have been hit not just by energy problems, but also everything else. The economy is not functioning very well. The city is not doing well against the expectations that it will benefit out of Brexit are not materializing. So the UK is coming worse off, and they don't have a government either. They don't make. They have deferred major decisions until next month. So the UK is suffering massively. Germany, I believe, will come out of it. It's not going to be a long-term problem. By next year, once the problems with gas are faced and sorted out, probably by using more coal, and obviously the new LNG import terminals are operational, and they can get hold of more LNG at high prices because, as you know, LNG supplies worldwide are limited. They're not going up in a big way, and most of them are committed. So if Germany wants to get more LNG, they have to pay more.
And if China was to lift its zero policy and go back into the LNG spot market, that would put a real big squeeze on the spot market for LNG.
But even China is going back into coal. I mean, the coal.
I don't think they ever left coal.
No, but they have going further into coal now. Commitment on coal is increasing rapidly. China is more or less abandoning climate change for the time being and going back to coal.
70% of its power generation this
from
year
coal.
is from coal.
And
Omar,
the same with India.
before we wrap up, I just wanted to get a quick articulation from you as to, I mean, you mentioned two very definitively different pathways. 110, we go up to the moon. 110, we go down to 60. What will determine which of those two pathways?
Russia.
Russia. By what? Curtailing supply?
Curtailing supply, and they can do it in many ways. So the Russians don't. The West is very blunt. They come up to you and they say, you know, we're going to destroy you. We don't like you. Blah blah blah. The Russians, they call you partners, but they can do it They can either shut Nord Stream 1, right, which will be a disaster. They can basically say you have to pay for whatever it is. You have to pay for nuclear, for the uranium that the Europe uses. 40% of it comes from Russia, enriched uranium for the nuclear power plants. 40% of it comes from Russia. They can say either we're going to stop that, or pay in rubles, or pay in gold, or pay in natural gas, or a million and one ways.
Pay in
right?
chocolate.
So, whatever. So at the end of the day, the problem that Europe has, I don't think is going to disappear now. I think basically it's existential in terms of not Europe, into the country Germany won't exist. No, but basically electricity prices are now so high that anything that Germany makes is uncompetitive. Anything at all, from washing machines to vacuum cleaners to cars to fridges. Forget it. It's
not if the euro is 60 cents.
No, even if the euro is 60 cents. Remember, the euro has moved 30%, 25% against the dollar, right? But electricity prices have gone like,
Right.
600% higher. So you can forget about and the other thing that people don't understand is the difference between LNG and coal, right? So let's say you're using LNG, right? Think about cooking, right? So let's say you use natural gas to cook, right? You turn the knob on or you turn it left and right, and the flame goes up and down. Very easy. With coal, you can't do that. It either burns or it doesn't. You can't do the controlling and all this kind of stuff. They're two very different fuels. So if you use them, let's say in power generation, the only way that you can stop with coal is by venting, all the steam or whatever it is off. With natural gas, you just turn the thing, increase the supply, heat more, decrease the supply. So they're two, and there's very many different types of coal. So, for example, the Poles, they bought like this coal, and they find that the coal that they have doesn't have enough energy. It's not as good as the Russian coal. So bottom line is, I think.
Well, the bottom line, as you say, is that Russia will German the direction. I suppose that's within OPEC plus, and of course the outcome of that. Let's get the survey result before we just close, because we're running over in time this morning. So yes is the view of this room, that the continued trend of prices will decline, and of course commodity and energy prices at these levels don't just target Europe or Germany. There's the whole world has to pay these commodity prices, and that is a very big challenge when the dollar value is at 110 or so in terms of the index. So these are paying for the whole world. We have to wrap it up there. Oil prices trading above $101 a barrel. Great to have everybody back. Omar back in his office. It's 5 to 8 in the morning in London. So thank God we're not getting on the tube. That's all I can say. Thank you, Victor Yang in China. And of course, Charles and Anas in Holland. Thank you so much. Have a great day, everybody. We're here every morning at 10:30 UAE time.